We'll go ahead and call the meeting to order. Today is August 16th, and we have our pension committee meeting. It's not listed on the agenda here, but we are required by state law, new law that went into effect July 1st, to allow for a public comment period. Council approved an ordinance regarding that information, and nobody signed up as far as I'm aware, so we will just go along with our second item on the agenda. Y'all have the minutes in front of you. Are there any changes or questions about those?
All right. I'm good. Everybody good?
Okay, we don't have Frida here.
What do you need?
Do you mind calling roll? I think she has a sheet right there.
She does.
Okay, so do I have a motion and a second?
Yes, I'm so moved.
Second.
Okay. We have a motion and second. Can you please call the roll?
Okay, Earl Hall? Hull?
Yes, Earl Hall.
Justin Burris?
Present.
Greg Sample?
He's out today.
Okay. Kathy Smith? Yes. Aaron Tucker?
Yes.
Austin Maxwell?
They're not here, so we're
Jennifer
just
Brown.
calling roll for the vote.
Attendance?
Not attendance, for the vote,
For the vote, okay.
for the minutes.
So your present was really a yes.
So, yes, okay.
Sorry. Thank you. Sorry about that. No, you're good.
Okay, so we have Natalka Bacalo here from Fiducian Advisors, and Chris Rowlands is on the call as well. We do have one of our committee members that will have to leave early, so I've asked for Fiducian to flip-flop the agenda items and review the core bond search first, so that we can make sure we get our votes in case that runs long. So, Natalka, I'll turn it over to you.
Okay, well, I'll just give Chris a little bit of a tee-up for the core bond search, and also for the benefit of some new committee members as to why this was conducted. You currently have, for the defined benefit plan, a team of 4 fixed income managers managing the fixed income portion of your portfolio. And they are... You have an intermediate core bond manager that has a credit bond, a corporate bond focus, all high quality, no high yield. You have a mortgage-focused manager, so they invest in treasuries, all sorts of mortgage-backed securities, asset-backed securities, again, no high yield there. And then you have 2 core plus managers. You have a multi-sector bond fund manager that manages very, high income sectors of the bond market. So a lot of high yield bonds, bank loans, investment grade credit bonds, a little bit of CLOs, really anything that generates a high yield would be in the multi-sector bond fund. And then you have a dedicated high yield bond manager. And one of the reasons why you have those core plus managers in place is, as you probably appreciate, for many years, the interest rates have been super low, between 0 and like 1 or 2% on longer term bond funds. So we were looking, and as many people were, searching for yield for the defined benefit plan. And so we went into high yield and multi-sector bond funds. Not the most comfortable place in the fixed income market, but it's where a lot of investors were getting pushed in the hunt for yield. It's actually worked out very well for you. It continues to work very well for you, but with potentially an economic slowdown, growth slowing down, and the rapid rise in interest rates, or if you want to call it normalization of interest rates that we saw last year, it's presenting a good opportunity to, if you will, de-risk your fixed income portfolio. So we're looking to improve the quality of the portfolio, take a little bit of that risk off the table. And, 5 years ago, I would say we were more afraid of duration risk than credit risk. That's flip-flopped a little bit now. We're more concerned about credit risk in your portfolio. We think that interest rates might have seen a top, or we're very near the top, and we might be in a period where they either stay at that level or pull back a little bit. So it presents a nice entry point to go into a core bond fund. So with that, I'm going to turn it over to Chris. We conducted a search, and he'll review that process.
Yeah, thanks, Natalka. And that's really a great background on really kind of the fixed income landscape today versus where we've been in the last 15 years. So like Murfreesboro, many pension plans, asset allocation settings have reached for yield over the years. And in doing so, you take on incrementally higher credit risk. And, the challenge with that is default risk as well. So I think the restoration of higher yields, significantly higher yields that we've experienced over the last year or so, represents an opportunity to, do a re-examination of fixed income. And it's not just your plan, it's other plans that we're working with in the public sector, and saying, how could we kind of maintain the duration profile but improve the credit quality? Where could we trim from areas of the portfolio that we think, we could temper back some of the risk profile. And so our manager research group is a really experienced and deep and tenured team. They do roughly 2,000 meetings annually with investment management firms and fund companies. So it's a very thorough vetting process, and then there's a really healthy debate and approval process at our manager research forum and our investment committee. And so you're really getting kind of the best thinking of the firm with respect to the overall due diligence process. So when we reached out to the group, we said, look, we're going to embark on a core manager process, core manager search for Murfreesboro, and we want to present those findings respectfully to the board and move forward. And I think when you do a process like this, when you kind of vet down from 20 managers to 15 to 10 to 5 to 4, whatever the final number is, you really can't go wrong, I think, with the managers that were presented today. They're all solid managers with attractive risk-adjusted returns. But I think at the end of the day, you also have to understand which manager we think best complements a client's existing portfolio as well. So you look at the managers in isolation, but then you also have to look at the managers in terms of how they are correlated or not correlated to those strategies, and how can they help achieve the objectives we're trying to achieve with regard to your fixed income portfolio. So the report that we have in front of you is a couple pages long. As Natalka pointed out, it is both qualitative and quantitatively driven. I think there's a more of a heavier focus on the qualitative side. So we do a lot of on-site visits. We do a lot of calls with fund managers and portfolio teams. So the report that you see before you outlines what we believe to be a really solid core fixed income managers that we have a high conviction in. So those managers are Baird, Johnson, TCW, and Allspring. Now, I will point out, as we were going through this vetting process, more recently this week, TCW announced some significant changes at their organization. Laird Landman is going to be retiring. Steve Kane, who also serves as co-CIO, and is also a portfolio manager on the core fixed income strategy, is retiring as well. So we think because of this disruption, we have placed TCW as an organization on watch status. So we are not deploying new capital to TCW because of those changes. So I think toward that end, we've identified, really kind of left with 3 investment strategies here: Baird, Johnson, and Allspring, and they're really focused in on that high quality core mandate where they're going to really track the Barclays aggregate bond index. And so Baird really, I think, to look at these strategies, it kind of stands out in a couple ways. One is the risk control features at Baird are key to their investment discipline. So we know that interest rates are really difficult to consistently forecast over time. What Baird does employs is a duration-neutral, risk-controlled approach. So the duration of their strategy is going to line the duration of the index. Where they're going to try to add value is across sectors and security selection. So we think that approach and the tenure of their team, as outlined here, kind of puts them a little bit front and center versus Johnson and Allspring. On the next page, you'll see some statistics. There's a lot of numbers here. I am not going to go through every single data point here, but the purpose of this exercise is now we're getting behind the investment number. So we know the strength of the team and the organization, how long have they been doing it. So let's look at some of the results. Let's look at some of their risk-adjusted returns. And if you look at sort of Baird against the aggregate index and against some of their peers, their numbers historically have been pretty solid. There's really no lumpiness to the strategy. It's kind of this consistent performance. And if you look at just to the right there, you'll see a column that says differentiators, and you look at some of these statistics that we examine, batting average and ability to add some value and volatility. And you'll see consistently Baird is ranked like number 1 or 2 in those type of profiles. So, we look at their portfolio strategy, we look at their investment results, we look at the risk-adjusted returns, we look at any headwinds or tailwinds to performance over the years, and we kind of wrap that up on the third page, or the last page, slide 5 as well, when we get a little bit longer in 10-year and 5-year metrics as well. And then we look at rolling periods of return, which tends to smooth out some of the return profiles, right? So a manager could have one really good year, and now their 3- and 5-year numbers look really good. Well, that's kind of distorted because they had one really good year. So we're trying to get outside of those kind of, one-hit wonders, if you will, and look for those managers that have delivered some attractive results. In addition to, I think Baird, complements the risk profile of your current portfolio on a go-forward basis because of its high-quality, conservative approach. We think they're probably a really good complement to your strategy going forward, and would suggest that the committee lean toward or retain Baird as a core fixed income manager.
So a lot of information there, but any questions?
I don't think so. I know as I reviewed everything, it looked like Baird kind of stood out on all the metrics, so I assumed that was probably where y'all were leaning as well.
Yes.
So what would be the next steps for the committee?
To approve the sort of the selection, and then we would notify Pinnacle.
Okay.
And they would establish the fixed income account. The funding of the new mandate, we were going to review during the asset allocation and rebalancing portion of the presentation, but basically we would be trimming some of the core plus bond managers to help de-risk the portfolio. Right. We would be trimming overweight large cap equities because they've become quite overweight because that's what's been performing in the marketplace. And we might trim a little bit of REITs to fund the mandate. And we would probably be looking to have this mandate, the new core bond manager, be somewhere between an $8 and $10 million allocation in the plan. So we might, do that all in one shot, or we could spread it over, 1 month or 1 quarter to do a little bit of dollar cost averaging. So we can take a look at that, but those would be the next steps.
Okay.
Did I miss anything, Chris?
No, I think you're absolutely right. So I would suggest that, if we're moving money from fixed income to fixed income, we could do that pretty quickly, right? So, you're remaining within an asset class. if we're moving from equities, as Natalka pointed out, you're taking, a little bit of overweight from equities. I think there you might want to employ a little bit of a dollar cost averaging strategy. So you're not taking money in one swoop out of the equity markets. You just, you're kind of minimizing some market volatility and risk and then stepping into fixed income a little bit more judiciously.
For you or Chris, in terms of what we've seen going on with China the last few days, and the fact the Fed, we don't quite know what they're going to do because we've had some more negative news, higher oil prices. What's your take on the next, say, 3 months in terms of the Fed stance?
Yeah, so I think if you were to look at the Fed has been very aggressive in raising rates. Last raised in July another 25 basis points, and is really data driven at these levels. Right now inflation's at 4%. We've come down from 9% back in June of last year, and the Fed fund rate right now is 5.25 to 5.50. So it's a policy rate that is above inflation. If you look at the Fed futures market, the futures market is anticipating no additional rate hikes by the Fed in 2023 and is anticipating a rate cut either late in 23 or early 24. As Natalka, addressed earlier, maybe you're going to see a little bit of a slowdown here in the economy. That's the reason why we're taking a little risk off of kind of the credit position and fixed income. We think the Fed policy, we're really in the ninth inning in terms of where they at with raising additional rates. And we think that's priced in as well, even if they raise another 25 basis points. But at the end of the day, I really do believe that the fixed income allocation is now providing that important balance that was just so sorely missing before. So, you could take the equity volatility as we've come accustomed to, and now you're just generating such a nice, yield in the fixed income portfolio that was sorely missing before, which could help to temper the overall volatility of the total portfolio. So, the silver lining to all this Fed activity of slowing down the economy for asset allocation settings like Murphy-Farrell is just you're getting a higher return profile in fixed income that's been sorely missing.
So, Natalka, we can take a motion to approve the recommendation for the bond search, and then should we go ahead and do the rebalancing now as well, or just do the fixed income piece? How do you want us to proceed on that end?
I would do the fixed income piece
Okay.
first, yeah.
Okay. Are there any other questions or discussion?
I'll just add, I'm somewhat familiar with Baird, reputational-wise. I've, heard a lot of positive things. So.
Great.
Yep. Yeah, I mean, one of the things when I saw the core bond search, I was sort of wondering why some of the big names, like a PIMCO or a Western, now TCW did appear, and you have TCW already in your portfolio. I reminded myself, we made this a core bond search. A lot of the other bigger names, the PIMCOs, the Westerns, even the TCWs, a lot of their strategies are somewhere between core plus and multi-sector. So they use sections of the bond market that you already have a lot of exposure to. And again, we weren't looking to replicate that exposure. We were looking to complement it with, a manager that would help improve the credit quality of the portfolio.
Right.
All right, I move that we, from the search, choose Baird Aggregate Bond Institutional Manager for that portion that we choose to go into the core bond fund.
Second.
Okay. Motion and second. Ms. Caldwell, please call the roll.
Mr. Burris?
Yes.
Mr. Hall?
Yes.
Ms. Smith?
Yes.
Chair Tucker?
Yes. Okay. So, sorry, was your motion also including the funding, the reallocation?
No.
Okay. So can we get a motion to approve Natalka's recommendation on the rebalancing?
So moved.
Second, when do you intend, I have a question. When do I get to ask that question?
Anytime.
When do you intend to make this move? When do you intend to do the actual rebalancing and putting the money into the fund?
Right, okay, so as soon as we contact Pinnacle, they'll give us a date as to when the new fund will be opened up for you. They may send over some paperwork for you to sign, but it will be like any other mutual fund account opening that they custody for you. And once that happens, we can send over the rebalancing. So I'm anticipating that it would be within a week to 10 days at most.
I think better, sooner is better if I'm hearing what you all's strategy is about the coming Fed and what we're seeing. The only thing that bothers me in all that is we still have high wage inflation, we still have consumer spending out the roof. We're not bringing, we're bringing some inflation down, but we're not bringing all the inflation down, so I don't know how the Fed's going to react to that.
Yeah, no, it's, so far rents, which is a really big
Yes.
part of the inflation number, have been stubbornly high.
Yes,
So other parts have come down quicker.
yes.
And I think we're going to see a bit of a lumpy path, but hopefully with a downward trend.
Okay, so we
We have
have,
a motion?
yes, we have a motion, and did you have the second?
I'll second that.
Okay, Ms. Caldwell, please call the roll.
Can I ask you a question? If they make the motion second, do I have to call them again, their names again for the roll? Okay. Mr. Burris?
Yes.
Mr. Hall?
Yes.
Ms. Smith?
Yes.
Chair Tucker?
Yes. Okay, well, I'm very sorry for completely scrambling our agenda today, but I appreciate.
Not a problem, we're very flexible.
Totally my fault, sir.
So,
So I think now we'll move into our second quarter and July plan information review.
correct, okay. So let me just downsize this. And the report will be up. Do you have it on your screen?
Yeah, we got
On your
it.
screens as well, excellent. But I'll also be referencing page numbers to help keep everybody on track and for those that might just have hard copies. So it's a new report format, the Fiducian Advisor report format for the second quarter. So I wanted to be here to the extent I could in person to sort of walk you through the format so that you would know where to find all the information. All the information that you're used to receiving is in this report and then probably more. And we can certainly tailor it if there are certain things that you like or certain things that you think are maybe too much detail, but at least you know what's available to you. I always start off my comments on performance with a brief market overview. So tab 1 of the performance report is a market update, and it's about 5 or 6 pages long, and it covers the economy and the various asset classes. For the purposes of this meeting and focusing in on what went on in the market in the second quarter so that you have a good feel for what the environment was that your investment managers and your plan was operating in, I'm going to guide people to page 4, which is the asset class returns page. So here we have the performance of really all the major asset classes domestically and globally, and divided into 3 sections. The dark blue bars at the left side of the table are the fixed income markets. The gray bars in the middle are domestic and international equities, and the lighter blue bars on the right-hand side are real assets, things like REITs, commodities, diversified real asset funds. And the bars with the numbers on top represent year-to-date performance, so January 1, 2023 to June 30th. The numbers that are in the circles are the second quarter performance numbers. So by presenting asset class returns this way, it becomes really easy to see that if we look at the fixed income markets, the dark blue bars on the left, that a lot of the numbers that are in circles are in negative territory. So bonds had a negative second quarter of performance. The only positive performing sectors of the bond market in the second quarter were high yield, bank loans, some investment grade credit, and emerging market bonds. Everything else was in negative territory. It was primarily driven by rising interest rates. March 31st, the 10-year bond was at 3.47%, and June 30th, it was at 3.81. So interest rates rose. That impacts, and they also rose on the short end. Interest rates rose across the entire yield curve. But rising rates at the long end impact total return more than at the short end. So long duration bonds were the most negatively impacted. You don't really have any of those in your portfolio. But your intermediate bond managers did not escape negative territory in the second quarter. However, your high yield and your multi-sector bond funds have done well for you, both in the second quarter and year to date, as we'll see in a few minutes. The middle gray bars are the domestic large and small cap market, and also international markets and emerging markets. Those had very positive second quarters of performance. The U.S. stock market was up, large cap stocks 8.6%, year to date up 16.7%. That year-to-date number represents the the highest opening 6 months of the year since the year 2000. And it was driven by the large technology names in our index. So the Metas, the Googles, the Amazons, Apples. It's sort of like what we saw with the FANG stocks. We've seen this movie before. Last year, they were the really weak performers in the market, the technology sector. They have rebounded very strongly in the first half of this year. Small cap stocks are doing well, but lagging their large cap peers, up 5.2% in the second quarter. International developed markets were up only 3%, but up a solid 11.7% on a year-to-date basis. And given everything that's been going on geopolitically and globally in the world, between wars and China's issues, I think a lot of people are pretty surprised to see such strong returns out of international markets. And I think that when you see the performance of your global and international teams, you'll be quite pleased as well. Emerging markets are having a tough year this year. They were up only about 1% in the second quarter and up only about 5% year to date. You also have exposure to some real assets. You have a commodities manager in place, and that was a great place to be last year. This year, a little bit tougher, negative 2.6% for the quarter and down about 7.8% year to date. A lot of that was also, made a comeback in July and August. Commodities rebounded very strongly. It's a volatile asset class, and it tends to be either your top performer or bottom performer. And you also have significant exposure to REITs, both on a global basis, global REITs, and you have two domestic REIT managers. And again, over the years, they have done very well for you. They were put in place, and that allocation when interest rates were very low because REITs throw off a lot of income and generate a lot of income, so they're a high income producing asset class. And they did great last year. This year, they're struggling a bit with the correction in the real estate markets, particularly with office space. So we might be looking to trim that exposure a little bit for you, but the income producing qualities of these funds still very strong. And it's still, this year, a better place to be in public real estate markets than private real estate markets. From a liquidity standpoint, much stronger position. So that's the market, what was going on in the second quarter. So now let's take a look at what impact that had on your portfolio. Any questions on the market before we move on? Okay, so if we go to page 12, or the first page behind the executive summary tab, we come to a table or a page that's called Portfolio Dashboard. And there's a lot of great summary information on market values, performance, and asset allocation on this page. So, if you're ever looking for a quick update on how your portfolio is doing, this is a fantastic page. In the summary of cash flows, upper right-hand table, you can see that you began the second quarter, the plan began the second quarter with $160.8 million in assets. You had $753,000 of net withdrawals. You had $4.2 million of investment gains during the quarter, and you finished the second quarter with $164.2 million in the plan. You can also see very quickly how the plan has done on a year-to-date basis, so a nice recovery after a weak 2022. And then, if you'd like, you can also see how the plan has done since inception. And I think that that's always, sort of a telling column to look at. I mean, your plan when we started working with you back in 2000 was $44.4 million in size. You've had $3.5 million of net contributions during that time period, and the plan has grown by $116.4 million. So, good markets, good asset allocation, good investment team, and that, you weathered a number of down markets during that period. And, the 2000 to 2002 time period, the great financial crisis in 2008, the COVID, so it's a good number. Over to the left-hand side, we see the performance of the plan, both recent as well as longer term. For the quarter, you matched 2.6%, so you matched the blended target index. The year-to-date number, you are slightly ahead, 6.4 versus 6.1. And your trailing one-year number is about 1% ahead of target, 7.6 versus 6.7%. And that's a number that we highlight particularly at the end of June 30th because the plan's fiscal year is a June 30th fiscal year period. So that is the number and that is the market value that goes in your books. And the other thing that's important about that number is we compare it to your actuarial interest rate assumption, which is 7% for the plan. And for all defined benefit plans, one of your primary targets is to meet or hopefully beat that actuarial interest rate assumption. It helps keep funding to a minimum and grow your plan assets, more organically through gains. So it was a good fiscal year for you. In the lower right corner of the portfolio dashboard table, we see the asset allocation of the plan. And we'll be talking about that more when we talk about asset allocation and rebalancing. And we'll actually be using the July numbers since they're a little bit more up to date. And whenever we talk about rebalancing in particular, I think it's good to work with the most current values. But from this chart, what you can glean is each asset class has 3 bars. The upper bar, which is sort of a medium blue, is your target allocation for an asset class. So the plan's target allocation is to be 34% invested in fixed income, 30% in U.S. stocks, 12% in international stocks, and 23% in real assets, your real estate and your commodities, and also a 1% target in cash for plan expenses and benefit payments. What you see in the dark blue second bar on on that table is the plan's actual allocation. And then the last bar, which is sort of a teal color, we probably should use slightly different colors here. They look a little too similar. But the fixed income is underweight 6%. Your domestic and international equities are overweight by between 3.5% and close to 4%. And your real assets are slightly underweight. And a lot of that is what's going to be taken care of when we fund the new core fixed income manager. So
We have been keeping cash a little over our target
Yes.
as well, on purpose.
Exactly. We have been recommending probably for the last 3 to 5 years that and certainly the last 3 years, that you keep 6 to 9 months of cash, meaning money market funds or cash equivalents, not short-term bond funds, but cash on hand to meet benefit payments and plan expenses. Particularly during periods of high market volatility, you don't want to be in a position at the end of a month to have to liquidate into a weak market if you don't have to. Having that extra cash on hand 3 years ago was a little bit painful because money market funds were earning nothing. This past year, it's been great because you've been earning 4% on that money. You've been earning more than you've been earning in your bond funds. So it's been a little bit less painful. And market volatility continues to be high, so we continue to recommend an overweight in your cash position. So we try to keep that between 1.5% and 2%. Okay, so now that we see a summary of the plan, and I guess the headline here is the plan's in good shape from a performance standpoint, doing pretty well. If we turn to page 19 of this report, we'll see how the teams of your investment managers have done, and how also the individual managers have done. So on page 19, the title of the page is Composite Manager Performance. You have the performance of the total plan at the top, so you see the quarter-to-date figure of 2.6% and your year-to-date figure of 6.4%. But then below that, you have your 4 investment teams. Your fixed income team, 4 investment managers. Domestic equity, you have 6 investment managers. International team has 4 managers. And your real assets team has 4 managers. Also, the performance on this, we show you the difference, both numerically and also in a color format, to show you whether your managers and these teams are over or underperforming their benchmark. So the goal with the color coding is the more green, the more pale yellow to green you see on this page, the better. It means you're either meeting, those teams are either meeting or topping their respective performance targets. Anything in pink or red is underperforming the target. So, I mean, you can see that by looking at the difference line, but we thought by color coding it, it just really, as soon as you turn to the page, you have a good sense of what teams are in good shape and what teams might be experiencing some weakness. So when we look at this page, clearly the domestic equity team is the only team that has pink and red on it. They are having, year-to-date, a weaker year of performance for you. It's the same team that you've had in place for a long time. Historically, their numbers have been better, and we're going to talk about, you know, where the lagging performance lies so far. The fixed income team is matching their goals. They were, as a team, down 0.3%. Their blended target index was down 0.7 in the second quarter, so they, you know, edged ahead, or excuse me, their index was down 0.2, so they dropped a little bit further, almost matched. They're a little bit ahead on a year-to-date basis. The domestic equity team, as I said, in the second quarter is up 5.6%, but that lags the 8% blended index return. And they also lag on a year-to-date basis. They're still up in absolute terms, the team 10.2%. So it's not as if they're losing money. On a relative basis, compared to their index, they're not doing as well. In absolute terms, they're earning a double-digit return. International equity, slightly ahead for the quarter, 3.6% versus 2.8, and nicely ahead on a year-to-date basis, up 12.2 versus 8%. And you can see that over time, your international equity team has been one of the strongest teams in your portfolio. Your real asset team, again, just edged slightly ahead of their benchmark, up 1.2% in the second quarter, and the benchmark was up 1%, and also ahead on a year-to-date basis, up 2.3 versus 1.5. So in sort of, you know, an adverse market for real assets, they're doing a little bit better than their peers. So now we'll go to pages 20 and through about 22, and we can see some individual manager performance. And I won't go through too much detail. I'll try to sort of pull out just sort of the highlights, but here you can see exactly who your investment managers are. Excuse me, on your fixed income team of 4, Pinnacle runs your intermediate corporate bond portfolio. It is corporate bonds, it's treasuries, it's some municipals. As I mentioned earlier, there's no high yield in this portfolio, and it is a shorter duration than the core bond manager search that we did, shorter duration by about 2.5 years. And Pinnacle dropped a little bit less than its target index in the second quarter, down 3.3% versus down 0.7% for the intermediate aggregate index, and they're virtually matching the intermediate aggregate index on a year-to-date basis, up 1.5%. TCW is the total return fund, that's your mortgage manager, and they're having a weaker year of performance. They were down 1.2% in the second quarter versus down 0.8% for the aggregate index, and the mortgage index were both down the same. They are up 2.3% year to date, a little bit ahead. So just had a weak second quarter there. And then your 2 core plus managers, Western Asset Income, that's your multi-sector bond fund, and they were up 0.5 in the second quarter, and they're up 4% year to date. And Lord Abbott is your high yield, your dedicated high yield bond manager, up 1.2% during the quarter and up 4% year-to-date as well. So those managers, which we are looking to trim on strength, we don't think that necessarily performance is going to fall through the floor in the next year or two, but we think that credit is going to struggle a little bit, so their significant outperformance might get dialed down a bit. And I think it's a good entry point, as we mentioned, for core bonds, and it's always, I think, a good idea to trim on strength rather than, weakness. So that is your fixed income team. Your domestic equity team, again, with the color coding, you can see where the weakness lies. And the weakness is in your large value manager on a quarter and a year-to-date basis, Brandywine Global Dynamic U.S. Large Cap Value. Value has been lagging growth, and unfortunately, Brandywine's value has been lagging their value peers and their value index. So, historically, they've done a lot better than that. You can see the green shades in the trailing 1, 3, and 5-year returns. So nothing's changed with their investment team. We think that they'll be okay going forward, but we're watching them closely. Pinnacle is your large cap core equity manager. They might have a slight growth bias, but they're pretty much a core bond manager benchmarked to the S&P 500. And they're doing a good job of keeping pace with an index that's being driven by 7 to 9 growth names. So they're doing a good job. The other weak manager is Janus Henderson Enterprise. That's your mid-cap growth manager. Historically, again, very strong performance. And this year, they're up a very nice, 12, almost 13% year-to-date, but that's lagging their target index, which is up almost 16%. So they tend to be, I would say, a GARP, a growth at the right price, a little bit more of a conservative mid-cap growth manager. That helped them a lot in the last couple of years when growth was out of favor, but it's hurt them a little bit during this very strong rebound in keeping up with the index. Your other managers, as you can see, are doing very well. You have 2 small cap managers, American Century Small Cap Value, all green on the screen, as they say on Bloomberg. Vanguard Small Cap Growth Index, it's an ETF fund, has given you very good small cap growth exposure, and for a very low cost, being an index fund. And then you also have a mid-cap value manager, Harbor Mid-Cap Value, which has done very well in their space also. So while your domestic equity team is experiencing some weakness, it's really centered on about 2 to 3 managers. We're not overly concerned at this point in time. We understand why they're lagging a little bit. We're hoping that the market comes around to their style, but I think that this also shows why it's really good to have both growth and value exposure. It's really hard to tell exactly when one's going to lead and one's going to lag, and it's hard to jump in or out at precisely the right times, so you're just better off having some exposure to good managers in their asset classes that can weather an adverse time for their style pretty well and minimize losses and participate well on the upside. And we think your team does that. And please, if you have any questions or you want a deeper dive on any of these, I'm very happy to do that. Love talking about these people, but we have a time schedule, so. Your international and global and emerging team is on page 22. And, once again, a lot of green on the screen here. The top two managers, American Funds Capital World and Janus Henderson Global Research, are global equity managers. So they both invest in the U.S. as well as international markets. American Funds Capital World also invests in emerging markets. Janus Global Research does not. They invest only in U.S. and global developed markets. But both of them are doing quite well. Dodge & Cox is your international stock manager. They have a core to value bias, and they've just done very well for you for a really long time. So, I'm not going to bury the headline. They do a good job there, so not too much more to say there. Invesco Oppenheimer Developing Markets, that's your dedicated emerging markets fund. And as I mentioned earlier, emerging markets have been a weaker spot in the market. The index is up only 5% or 4.9% year to date. They're up 11% year to date. So they're having a good year. Last year was a bit of a difficult year for them, particularly the first half of 2022. You see a little bit of that in the pink 3-year number, picked up on some of that weakness, but they've rebounded rather nicely. So we continue to like them in emerging market space. And then the last team, your real assets team. As I mentioned, you have 2 domestic REIT managers. One of them is Cohen & Steers Realty at the bottom of this page. They're outperforming their target, up 3.2% in the second quarter, up 5.6% year to date. A lot of green since you've hired them. So, they're doing very well in a space that's currently challenged. And then on the next page, we have Principal Real Estate. That's your second U.S. REIT fund manager. They're also all in the green and doing very well. PGIM Global Real Estate is your global REIT manager. They've been on board with you for quite some time, 10 years now, and doing quite well in their space as well. And then you have your commodity natural resource manager. And sometimes it's painful to be in commodities, and sometimes they're the winners. And you've been in this fund for, again, about 10 years. And commodities, it's very hard to time entry points. And as they say with the lottery, you've got to be in it to win it, and it's just really hard to jump in and out at the right or wrong time. So you have a 5% target to commodities, and sometimes it's hurt you, a lot of times it's helped you, and I think that it's good exposure to have for a plan of your size. So that wraps up my comments on the plan's performance, the teams, and the individual managers. Does anybody have any questions or concerns on any of the managers?
Is Fiduciant going to do the same thing you all used to do? Is if we see a fund that's lagging, let's say a couple of quarters, it'll go on a watch list and we'll get a notification?
Yep.
And I guess we would see it in this report also.
Absolutely. In fact, Earl, if you look at the last column, it says it's called manager status. So these are all sort of maintained, and Fiduciant has a watch list status as well, so it will show up there. Absolutely. And then, on the following pages, if you're interested, there's calendar year performance for your team. And one of the interesting things when you look at calendar year performance is you're going to see a lot more pinks and reds But it's really amazing that when you then flip up and you roll it up into trailing period performance, a lot of that gets mitigated. So again, it's just sort of sometimes reinforcement to be a little bit patient sometimes with asset classes and managers, because they can't always be in the top quartile every month, every quarter. But over long periods of time and trailing period returns, you have a lot of green. I will also highlight that on page 30 of this report, we do an estimated fee analysis for you, and that'll come out every quarter. And right now, it breaks out all of the fees by investment manager and also by team. And for your plan, the average expense ratio is 55 basis points per year. And you have very few index funds in your lineup, and your active funds are priced very well when you look at their fees. I mean, for example, Pinnacle Fixed Income and Pinnacle Large Cap Equity are 28 and 29 basis points. Very fair numbers for a large cap actively managed equity portfolio and an actively managed bond fund. So you can see what all of the fees are, and again, we keep track of that. And also the Baird fund that you selected for your core bond fund also happened to be the best priced of the finalists in the core bond fund search as well. Also in this report, behind the manager fact sheet tab are manager fact sheets for all of your publicly traded mutual funds. And they're 3 pages long and have a lot of information on how the funds are invested, sectors, risk statistics, a lot of information. And again, happy to go into that with you for as much detail as you want. Know that it's there, but unless somebody has like a real specific question, it's good reading material for you. Chris, are you still there?
Absolutely.
Okay, just hanging on my every word, right? Very captivating. Before I went into asset allocation and left sort of this report, I thought that maybe you could say a few words on the fiduciary governance calendar process
Sure.
that Fiduciant has.
Yeah, and that's on slide 78.
Yep, the first
so
page
I'll give
behind appendix.
Maybe the committee a moment to get there, but you can see the optics on our fiduciary governance calendar and really the kind of the cadence that we have each quarter. So we designed this fiduciary governance calendar to focus on a couple of topics really outside of the investment review. So there's a couple of topics that we want to elevate to the governing body, stewards of the plan, that we think are pertinent and allow you to make better informed decisions with regard to the oversight of the pension portfolio. So you'll see in the second quarter, as an example, we focus on practice and policy. So what does that mean? So we review the investment policy statement this time each year. So right, that's front and center. We ensure that the language is current and up to date, that there's no changes to the asset allocation or the appendix that would warrant an amendment. And then you'll see a bullet point fiduciary training, right? So I began my career at the city of Hartford. I spent 7 years on the public side. I kind of have sat in your seats as an example. And, we often get the question, well, we know we're not under ERISA, right? But what should we be doing throughout the year as stewards of the plan? Now, Tennessee has the Uniform Prudent Investor Act. Most states do, and which really defines the duty of prudence and loyalty. So kind of under the state statute, we want to kind of explain to you what are some of the best practices that you should be doing as a governing body, and that's frequency of meeting and minutes, et cetera. I think you're doing that, but we bring that out as a friendly reminder. In the third quarter, you'll see municipal landscape. And so we have about 160 municipal plans, pension plans, that we advise to. And that provides us a really rather robust database with regard to trends that we're seeing across the public landscape. So around funded status, discount rate, asset allocation. And, we bring this front and center so you can get to understand kind of what are your peers doing around asset allocation or around a discount rate. And we also want to partner with the actuary, want to have open dialogue there. So we often participate when the actuary comes out and presents their findings. Are there any changes to the assumptions that would influence our thinking around asset allocation? And then you'll see in the fourth quarter, excuse me, it's just a re-examining or re-underwriting of the investment portfolio and the asset allocation using our most current capital market assumptions. So we develop these capital market assumptions each year. We run some asset allocation modeling, and then we come back to you and say, okay, here's some of our outlook for the next 10 years. How does that influence our thinking around the portfolio on a go-forward basis? So each of these topics are kind of front and center each quarter. We have some slides that we dedicate to the topic, and it's just designed to really engender this discipline throughout the year. And we're covering what we think are some key topics for you as stewards of the plan each and every quarter.
So, yeah, I think that it'll be very interesting to see that sort of the municipal landscape with the number of municipal plans that Fiducient advises on, just to sort of see what your peers are doing, what trends, are occurring.
Yeah.
Might be very interesting. Okay, I was going to wrap up with the July asset allocation. We've sort of, touched on asset allocation and rebalancing a lot in the comments that we've made. This is not something that we have a slide for, but Frida, do we know if the monthly flash was handed out or? Oh, perfect, so we have it in front of us. So this is, sort of a monthly flash report, separate document. And again, it's a new format that we're using, but things will be, look familiar to you because we're using some of the same tables that we use in the performance reports. And if we go to page 3 of the performance dashboard, or of the monthly flash report, it is the portfolio dashboard table. And, there, the top half gives you, again, market values and performance for the month. So, for instance, the 1 month asset value, you began the month at $164.2 million in assets. You had $257,877 of net withdrawals from the plan. In the month, you had almost $4.8 million of investment gains, and you finished July at $168.7 million. So it was a good month. It was a good month. From a performance standpoint, you were up and once again matched the index that's over in the left-hand table for the month, 2.9%. On a year-to-date basis through July 31st, your plan was up 9.5, edging slightly ahead of the 9.2 target policy. And then down in the lower right corner of this page is the asset allocation versus target. And here we see that the fixed income underweight actually grew a little bit because equities once again outperformed fixed income in the month of July. So you're underweight 7% in fixed income, and then domestic equity and international equity represent the most overweights, each around 4% overweight, and real assets about 1.6% underweight. And your cash levels are at 1.6%, so good amount of cash for paying benefit payments and other plan expenses. So as I mentioned earlier, on page 5 of this report, we don't have did not have any specific rebalancing recommendations as of July 31st. We wanted to wait for the committee to make a decision on whether they were going to engage that core bond manager. And on page 4, when we go through the asset allocation commentary, bolded is that upon selection, the new manager will be funded by trimming overweight equities, trimming REIT exposure, and trimming your more high-risk or volatile bond strategies. And that's exactly what we discussed earlier. So as soon as the account is opened up, we will provide you with rebalancing instructions. So, and that, I mean, that may end up coinciding with the August 31st,
That's true.
you know, so, because summer is going just that fast. So really appreciate the time that you took to review the results. You know, always very happy to be here in person, particularly when I have good news to deliver. It's always a little bit more difficult when there's harder and more difficult news to deliver. And really appreciate your taking the time to walk through the new report format. Please get back to us with any feedback on, you know, if there's information that you're not finding or, you know, that you feel can be trimmed from this report. We're happy to work with you on customizing a report that you like. Thank you.
Are there any questions for Natalka or Chris? Thank y'all both for all of the information today. And it's a big amount of information we got, and we appreciate the core bond search and all that went into that as well.
Terrific.
Okay,
Thank you.
so in your agenda packet, you had just an information-only sheet. This is just kind of statistical and historical information about the plan going back a number of years. I thought it was interesting. We talked about the plans, you know, amount since the plan's inception, but looking at how much the plan has grown just since I came here, and I came in 2008, and I think it's up, you know, somewhere around, you know, 90 million since then. So we appreciate all of your hard work, Natalka.
It's been a pleasure. Let me know.
Well, thank you.
Most years, it's been a pleasure. Certain years.
And I want to formally introduce the committee to Mr. Justin Burris. Justin is replacing the spot vacated by Charlie Myatt, as we all worked with him for a number of years on this committee. And you work for First National Bank of Middle Tennessee as the commercial relationship manager?
Correct.
Okay.
Correct. So I primarily work with our corporate and business customers for just various banking needs. So
Well, we're very happy to have you on board. So thank you
Happy to
very
be-
much for agreeing
appreciate it.
to
Absolutely.
join the committee.
Absolutely. Thank you.
Okay. Well, if there's no other business before the committee, we'll go ahead and adjourn. Thank y'all.